Welcome to the latest episode of the Auto Futurecast with me, Chris Kirby, in association with Tomorrow's Journey. Today we're joined by Marc Spurling from Aon. Marc, thanks very much for taking the time to join us and taking the trip across a not so warm London today. Marc, first of all, just if you wouldn't mind giving our audience a brief introduction, but both to yourself and your extensive career, but also, although Aon is a brand name people I think would recognise, maybe not fully familiar with what you guys do, and particularly in the context of auto and mobility and that side of things.
Yeah, thanks ever so much, Chris. Well, it's great to be here, and thanks ever so much for the invitation. Great to be on my first Futurecast podcast. So myself, I'm Executive Director for Transport and Logistics at Aon. So I've been at Aon 7 years. I've got a background in strategic consulting, working with large corporates, large insurance companies across liability classes. And I started out as a private practice lawyer, which is sort of where I first got into mobility. For Aon, I guess transport and logistics is pretty wide encompassing. So it thinks about marine cargo, it thinks about aviation, but I specialize in wheels on the road. So deal with everything from that. So that's mobility use cases across micro mobility and others, but also commercial motor. And I think you said, Aon, probably a lot of people do recognize us, probably think about us as purely an insurance broker, I think, but we actually like to be thought of as a professional services firm providing a sort of range of advices. We have 60,000 colleagues globally. We operate in 120 countries. And I guess we think about our business in two ways. One is we are sort of experts in risk capital. So what does that mean? That's how do we help organizations protect their balance sheet from risk? And that could be through insurance, or it could be reinsurance programs through captives. We place about 125 billion of insurance premium in the global markets and about 60 billion of reinsurance premium. So that's one big part of our business. And what we see is that actually for a lot of organizations, up to 2/3 of their risks are actually uninsurable or partially insurable. Right. So for us, it's more about actually, what can we insure, but also how do we advise people in terms of putting aside and protecting balance sheet from things that are not insurable. The other part of our business is around people. So we call that human capital. So we divide that into a lot of different skills and specialties, but it's essentially sort of health, well-being, benefits associated with people. But we then bring it into sort of what are the risks and personality perception challenges around behaviors, and also how do we address the war on talent, which obviously is a really big area for mobility. So we do that by sort of pay gap analysis, benchmarking of pay standards, but also then thinking about sort of innovative programs to provide rewards and retention strategies.
Yeah, okay. So very wide ranging, which I think is why I was asking that question in the first instance, because I think there's always a lot of these really well-known global brands who probably people only recognise a very small part of what they do. So it's super interesting. And I think I wanted to start with this was just looking at some of the challenges in mobility and EV. So I think quite widely in the industry, people were talking, what's one of the challenges generally in the market? Insurance is one. Premiums have been increasing, whether it's private or fleet. A lot of that has been EV related. Then we look at some of the subscription and more kind of bundled type products in the market also have become more and more expensive due to increasing insurance. Some companies have had to stop providing insurance even in that space. So just give us a little bit of your take on that, and we'll probably dive into a few areas, but that's kind of the area I wanted to start in, really.
Yeah, no, that's great. I mean, I think definitely we've seen it as a challenge, and I think we think that actually this is rooted in what we call 4 mega trends. So actually there's sort of these 4 global trends which are really impacting organizations and the availability of capital and the way decisions are made. And it's around weather, trade, technology, and people. And actually what we're seeing in the sort of, whether you're a multinational business in mobility or a startup, we definitely see that these new risks are coming along, creating more complexity, and that creates volatility. So Why is that a problem? Well, volatility is uncertainty, and uncertainty in insurance means typically less capital is applied to insurance solutions, and that makes it more expensive. So definitely when we see battery electric vehicles and the transition around new models for it, we are seeing a number of competing challenges, whether it's the technology, whether it's supply chain, which are impacting on the way in which risk is priced. So how does that play out? I guess what we see is, from a sort of an adoption perspective, we see this worry about technology. Is it going to give me the range I need? Is it going to last and have the longevity that I want from an asset base? But also, is there a risk that I could lose all my value in my vehicle because it just dies for whatever reason? And I guess there's also then a lot of myths and misinformation, if I can put it that way. So people are not really understanding the technology and its benefits.
Yeah.
So for us, it means insurers, that there are fewer markets willing to put their money behind this type of technology.
Yeah.
We definitely see overly cautious pricing. So actually, thinking about the risk is much more significant. Therefore, the insurance company needs to protect itself by increasing the price load to take account of the downside. I think there are some aspects of lack of knowledge around the technical aspects of the technology, and we'll perhaps come back to it.
Yeah.
I think data use is a big area. I think there's an underutilization of data that could really help in this area. And then I think there's a lot of people are just sort of still waiting to see what happens.
Yeah.
And actually, that's the worst of both worlds.
Yeah, it does feel like that's a bit the case with BEV generally. I remember interviewing Toby Poston from the BVRLA a couple of years ago now, talking about SMR on BEV, and he was going, Mark is really worried about it, super high costs.
Yeah.
And actually 2 years down the line, everyone's gone, it's not actually that bad. In fact, it's much better.
Yeah.
So there was this kind of thing of like, battery electric vehicles are going to be really good for SMR. Then there was the first batch of data said they weren't. Yeah. So then everyone panicked, and actually then like the longer stretch but bigger data pool. And I guess that's the problem with EVs is whilst we're seeing big EV adoption, a lot more cars on the road now, those vehicles are 2, 3, 4 years old. There's not really that big pool, and the vehicles that are older are in such a small number. You're kind of looking at that size of park. So I guess that data that's there just isn't the same as it would be on an ICE vehicle.
I mean, definitely that is part of the challenge, and I think again, insurance is they use data to try and extrapolate forward and try and predict, and that is in a small sample size. That is the risk. Yeah. You end up actually thinking that some of those trends are going to magnify into quite substantial risks. I think our experience certainly of working with clients that have adopted or been early adopters of BEVs is really positive. So I think I've worked with a number of transportation businesses where actually they've been running quite significant fleets for a number of years, and they are really positive about the technology. That they're saying low maintenance cost, very reliable, and they're now sort of starting to solve, or they've solved a lot of the initial challenges, and now thinking about the upside, where the opportunity is. But we'll come back to that.
Yeah, absolutely. No, I definitely think that's and the data stuff, I think also we'll come back to as well. Yeah. You also touched on the kind of supply chain challenges. Again, a lot of stuff that's reported. I guess a lot of this is caught up in the historical data, but this thing about battery electric vehicles being more expensive to repair. Yeah. There's a lot of new players into the market, which I've sat on this sofa and talked to lots of people about in this series in different ways, Chinese manufacturers, but also I guess people like Tesla and other people into the market is getting unknown supply chain for both manufacturer and non-manufacturer parts. Is that having an impact as well? I guess that's impacting that unknown cost side.
I mean, I think we still see that as a challenge, and I guess from an insurance point of view, that we see it through cost of repairs. So particularly post-accident, I think it is improving in the sort of personal line space with private cars, right? I think because there's been an increased adoption, and some of that's linked to salary sacrifice schemes, which have been really positive. I think, we're seeing that a number of the big players in that space are getting much more comfortable with the risk, and therefore there's the volatility set in the UK market has reduced around their pricing. I think what we do see is still a big gap in the commercial market. Right. So commercial insurers still not really seeing the volume there. So they're still at the start of the curve. But I think ultimately, we do see still quite significant costs. So Equity Red Star published a study earlier in the year, which looked at a number of different papers around the trends for claims inflation. Yeah. And they were sort of suggesting that claims inflation for battery electric vehicles can go up to 25%. So between 14 and 25% is the sort of place. So that obviously is significantly higher than, retail price inflation or retail price index or CPI. And I think the challenge there for organizations is when you're trying to budget on growth and you're predicting, 6-8% growth, this type of increased cost is quite significant. So I think what's sitting behind it, a couple of things. I think the fact that actually, because the market is still relatively new, there are fewer repair outlets for battery electric vehicles. So that typically means they have to get taken further. There are, you mentioned life cycle and parts is a big challenge. I think it's improved. I think, obviously the pandemic caused a challenge because, the global supply chains were very constrained. And I think we've seen some recovery from that point. Yeah. I think coming back to our sort of mega trends, the current, uncertainties on the global economy do introduce those risks again. And I think we are fearful that, if some of the sort of negative impacts of potential tariffs come in, that could create additional pressure. But I think the other thing is, these vehicles are just much more sophisticated. They've got a huge amount of sensors. They're by nature more complex, more expensive, and that of itself is a challenge. And I think the last piece is the people point, which we often forget about in this because we're so focused on the technology, but there aren't enough technicians. Yeah. This is new tech. It's not like a conventional vehicle, and actually there are not enough technicians and mechanics coming through, and that's, I think, a challenge for the industry.
Yeah, definitely. It is always those kind of unseen things. So I'm guessing from a bodywork perspective, bodywork is relatively straightforward, but it's the other things. I think I always like a random anecdote in these sessions, but my only ever accident when I worked for Vauxhall, I had some black ice on a road and like very lightly crashed the front of my car. And it was a company car. I worked for Vauxhall, didn't really matter, but I remember seeing the bill for the repair, and it was at the time like 700 quid, and I was like, it's literally a bumper, but the washer bottle was behind the bumper and it split and it broke all of the tubing and everything. And so it was this whole replacement of like a whole system in the thing. And I was like, I literally just bumped the bumper into a thing. And I guess then that's multiplied now by, it's a knock on the front, but that's actually impacted the side camera or the LiDAR sensor or other bits, which then become not only expensive to repair, but also more specialist in that sense. It's like, I can fix a bumper, I can fix a washer bottle because it's a general mechanics piece, but actually, I need to fix this LiDAR sensor on a Lotus, right? Well, it has to go back to the Lotus dealer because they're the only people that know how to do it. And their LiDAR man is really busy because he's got a million things going on.
But that's exactly right. I think, the innovation, I guess, and the intellectual property that a lot of OEMs are building up means they want to retain some of that specialism. And that is creating a challenge when sort of these unforeseen events occur, because it's slightly different to sort of taking your vehicle in for servicing, but it is causing a constraint. I think, again, it's improving. We are seeing insurers building up networks of providers that can that they can sort of be more fluid with in order to address the challenges, but it definitely is still a challenge.
Yeah, absolutely. And then kind of moving, so that's thinking about the EVs specifically, and one of the things that we kind of, when you're talking about the global mega trends, and I'm thinking of kind of like auto mega trends, you've got EV and changing business models, and those two things seem to cross over a bit. Not all subscription models are electric, but there's a higher proportion of electric vehicles in subscription models. Also, actually, I think the impact of salary sacrifice, because essentially that is a bundled product when it's sold, whether it's not bundled technically, but the consumer through the business is taking a product that has everything included in it. What are the complexities around that? I guess there's probably two parts to it, but the subscription one is definitely an interesting challenge because of the way it's priced.
Yes, definitely. I mean, I think it is challenging. I think really it's very much dependent on the way in which the offer is going out to the end customer and who that end customer is. And I think you've got sort of the B2B to C models. I think you've got more flexibility in there because you have the potentially to utilize a corporate structure to use those economy of scales to push down through. So salary sacrifice is a good example of that. That's what we see businesses utilize those models. I think where we see I guess it becomes more challenging is for the really innovative models that are doing these sort of B2C, direct to consumer. That brings in a number of different challenges, particularly from an insurance point of view, because it's much more regulated. You have consumer duty, so you have to think about who's framing the insurance offer, how are you framing that offer. So I think those structures are really important. And actually, when we talk about subscription models, I think with all the innovation going on, we forget that actually it is predominantly a form of leasing.
Yes.
And actually, whether it's short-term, long-term, or medium-term, that's what it is. So actually, when we deconstruct it and come to talk to clients, we're sort of going, actually, if we understand what you're trying to achieve, that, leasing models have obviously been around for a long time and they've been insured. So we can create structures that support that. It could be a sort of corporate umbrella structure that then you feed into, which is essentially what salary sacrifice schemes do. But I think as soon as you start to individualize products, that's when it becomes more complex and more expensive. And I think particularly for new businesses starting up, I think the challenge for them is just the capital allocation towards insurance. The big OEMs, most of them have been used to, they've got very big balance sheets to sort of manage these sort of volatilities. New players don't have that ability.
Yeah, definitely. And then when there's big swings, it can cause a big challenge. And I think that's definitely one of the things that we see with our mix of subscription products globally that we work on. In certain markets, as you say, it can be a flexible form of leasing. It can also be a long-term form of rental. And again, how the insurance can be applied in those scenarios is different. In the UAE, it's running from the Hertz fleet and it's basically just on the rental fleet insurance. They don't care who the driver is. It's insured in the same way. When you're looking at stuff more in the UK and Europe, tends to be more individualized, which then is a bit of going, oh, well, if you've got a younger driver in a bad postcode, that's a much higher risk than an older driver in a different postcode, but they both might be trying to get the same Hyundai electric vehicle. How do you either price it so they can both pay the same price, but then it's less competitive for the good insurance risk and more competitive for the bad, or you have to price it accordingly, which means you can't communicate your pricing properly. So you get this kind of weird balance the whole way across. It's really hard.
And again, the consumer duty, how there has to be transparency in the pricing, and that is the one big challenge. Is so how do you create something which is a customer can understand and is fair. I think that the key for us on that is, I think we would typically sort of think about it in the terms of, what's the minimum requirements, and what is the capital market, insurance market going to place on it in terms of any limits or exclusions. Again, using, a broader corporate structure gives you some flexibility on that. You might have more favorable exclusions or limitations on the policy. I think, what we see is to attract capacity, you start to bring in more sort of, I guess, more of a risk focus in terms of selection. That has to be done very responsibly and carefully. And I think, we've seen, or we saw certainly probably post-pandemic, real push around, I guess, dynamic pricing, pay-per-use, that type of model. I don't think it's really taken off for a number of different reasons, but I think ultimately it's about actually, ultimately what is driving risk, what is the information or feature which is ultimately determinative of price. Insurance has been quite blunt. It's historically really been age and address.
Yeah.
And I think, the regulations are changing so that those, age certainly is not something you can use to determine. But other risk factors might be relevant.
Yeah, interesting. Yeah, and I think that's definitely the bit. And I keep teasing the fact that we're going to talk about data later on, but also it's a can of worms. You have to be careful of how much we open it. But there's definitely opportunities for talk a lot about how outdated the industry is with a lot of these kind of supporting services. I guess clearly the vehicle itself has moved on a lot, particularly with BEV. But we're still broadly financing vehicles how we financed for 100 years. Yes. We're broadly insuring vehicles how we've insured for 100 years. So there's definitely a lot of room for innovation, but also the longer those things have been in place, the harder they are to move away from, because somehow you kind of have to link it back to like we say with subscription. Subscription's either a lease or a rental. Well, it could be its own thing, but it kind of gets pegged to one of the two. And I guess insurance it's either fleet or it's a individual insurance, and it has to match those things. So
I mean, I think we definitely see a lot of innovation in that subscription space, and I think it's an interesting model for us. And I think you talked about sort of embedded models. I think that they are very interesting to us, and salary sacrifice is a good example of that. It's probably the sort of most sort of pertinent example that people would think about. You've got your effectively you sacrifice your salary and you've got an embedded lease cost for the vehicle, and insurance and a number of services come into that. There are challenges around that type of model. There are not a lot of players in terms of the insurance market that want to lock in, because actually what we're asking them to do is lock into a price for the period of the lease. So again, we come back to volatility and uncertainty. They're sort of banking on the fact that that's a good risk and they don't have problems. And again, so when you come into the inflation challenge, this is where for electric vehicles, if you're locking into a price and actually everything's going up at 14% or 20%, that becomes a challenge. And that is something that we're seeing in the market, which is why there are a few players. I think, again, we look at it and go, there are ways to give greater comfort around how you can give yourself certainty. Is think about more informed approach to the way in which you're setting your pricing, so that you understand where your tolerance is for swings in that risk. And again, it's about making sure it's commercial. It's still got to be viable, but actually being informed around how you think about that pricing is quite critical. Yeah,
and I was going to ask about the kind of multi-year part of salary sacrifice. Again, it's probably another one of the locked in legacy parameters for insurance, isn't it? It's a aged location for a year. And how it's typically always been priced. And for a long time, there was a bit about, if you wanted insurance for a shorter period of time, insurers didn't really like it very much, because I guess lack of commitment. Now, in a lot of cases for salary sacrifice, asking to commit for 4 years. And like you said, some of that uncertainty, even if it's general inflation, but thinking the impact of suddenly a 20% tariff on Chinese imports, all of a sudden that puts all the parts cost up by 20%. You have to suck that up for 3.5 years or whatever. So definitely gets challenging, but clearly a part of the market that is growing or is a bigger sector as well.
I mean, I think, we see it. We're actually working with very large leasing business at the moment, which has, this precise challenge. They're shifting the bulk of their assets across to battery electric. Their historical pricing has been set at a particular level. They're concerned actually, that they may have a sort of contingent liability building up. So I think, for us, it's educating, and working with people so that they can understand it. I think the other piece on this is the recognition is, in many agreements, the insurer probably has the ability to renegotiate. But the challenge is the business is probably unlikely to be able to renegotiate with the customer. Because the contract will have had that fixed price with the terms included. And that shortfall is the challenge for the commercial organisation. So for us, it's about, okay, if we know that is a challenge, how can we help them to think about, when does that challenge become a problem?
Yeah, definitely. I think that's part of the thing with this as well. I've always been really intrigued by you mentioned earlier pay per use model, but worked on some stuff nearly 10 years ago now on how that could be done in the context of a vehicle. The problem is customers have been used to having a fixed payment, and actually, if their average payment over the course of the year could be less, if it was variable, it's still a thing that's uncomfortable to them. And I guess that's the same for insurance. If you went, you can have a much cheaper insurance price. If it's a price that could change every 3 months, people are still going to go, well, that really scares me. So in a way, kind of overpaying to cover for the risk. And it's the same thing in the vehicles themselves. There's a risk around what the overall usage is of the vehicle. There's a risk in the residual values, and those all get pegged in. So customers paying in their 500 quid a month salary sacrifice, they're probably paying like 30% of it is covering everyone's risk. So it's interesting.
I mean, I think you've got that challenge around on the pay-per-use thing. I think what we saw is actually everyone wants the upside, i.e. the saving because I'm a good driver, but actually you then don't want to budget and realize that actually if you either do more miles or you're a riskier driver, you're going to pay more. I think there is still appetite for it. I think it's just, perhaps the design of some of those models wasn't as optimized, and particularly the way in which they were communicated. But I think what we see in the commercial side is actually, again, businesses want certainty, and actually the planning around pricing is it's a longer term aspect for them. But I think what they do say to us, and what we heard very clearly, was one of the problems they have with a traditional approach of insurance is you sort of, how long before I see credit for all the good things I do? Do I have to wait 3 years before you're actually going to tell me I've been a good boy and I can get some money back? And actually, we want to see if there's a way of actually sort of finding a middle ground. So how can you get credit for improved risk or managing risk earlier, so that it's, you're not waiting for for an actuarial model to show you that it actually has followed through. Yeah,
absolutely. And but also without opening the risk on, because there's always risk and reward right with these things. And if you're locking in your price, it's fixed. But you also don't want a thing where one of your drivers gets hit by an uninsured driver, you get a huge claim, and all of a sudden your policy goes up next week. There's these the kind of balancing acts that you need to manage. But there definitely feels like there's more, whether it's consumer or fleet or fleet into consumer, there's got to be sort of a better middle ground, a sharing of some of that risk and benefit, I guess. And
I
opportunity.
We definitely see, I think, people that work in the sort of mobility space are, seeing the way technology is driving a different, I guess, perspective. And particularly with a lot of new businesses coming in, that they are digital natives. And so their appetite and understanding of their own data and business models are very different. And I think that is causing or creating some impetus to improve. And certainly we do see, innovative insurance markets that are willing to think differently. We work with Lloyd's syndicates that actually, are very innovative in terms of how they think about risk and what they're prepared to back. That some of those syndicates are behind, the backing of different wording for autonomous vehicle policies. So again, it is definitely there. I think it's just a question of how we can help to amplify and grow those type of approaches.
Yeah, definitely. And like teasing the best match of the weekend at Match of the Day and saving it till last, I'm going to mention there's another good point around data, which we'll come back to very, very shortly. But I just want to touch on one thing first, with something that we picked up on our briefing call, talking about the infrastructure and some risks related to that. So again, another area that I'm guessing in our listeners' sphere in the automotive space, again, where everyone's sort of comfortable with motor risk, although understanding there's lots of change, and I think we've clarified or helped to understand some of that. But there's also some new risks coming into the market, particularly around BEVs and the infrastructure. But tell us a bit about that and some of the work you're doing in that space.
So I mean, I think there's a couple of things here. I think you've got the sort of adoption of the technology in the first place. So the businesses that are going, okay, how do I go from effectively a business that uses conventional combustion engine vehicles to battery electric? So a lot of that is just around the asset value, the fear of that, how do I finance it, and everything else. What we're now seeing, I think, with businesses that have started to make that step, and they've got good investment, good proportion of EVs in the mix, they're starting to see the challenges around infrastructure. So I guess that comes, I think probably most pertinent is, how they think about the charging infrastructure, and also then how is it paid for? Because again, traditionally, business models around conventional vehicles, you have a fuel card, relatively easy to monitor and check. But actually, how do you manage public versus private charging in an electric vehicle? So I think it's a super interesting area, and it's something that we're thinking about. I mean, I think one of the key considerations is, again, it's about planning for organizations, because what we're seeing is there's sort of that step change of, I'm going to invest and get some EV assets. I think I know how many I want. I'm going to assume that I'm going to be able to charge everything at my central base. And I need to have, say, 10 charging points for that. What we've seen is, though, that actually there are potential constraints on that decision, which people don't find out until the last minute. So almost they've made a number of decisions and then they find that there are barriers. So what are those barriers? Could be the property insurance. Property insurers really, still quite traditional, very worried about the negative risks of battery electric charging points and the potential, obviously, for fire risk. So, premises owners might place restrictions on what is or isn't possible, and that might be either because of their own appetite or linked to their own insurance. I think the other thing is you have to think about, what is the infrastructure in terms of the load capability in the building or premises that you're in. Is it going to be able to maintain the level of power that you're going to require, which is really important. And then space. Space is a big factor. You need a bit more space around to enable it to happen. So those are all costs. And if they're not well thought through, it can be a real challenge. And I was hearing a story, it's talking about anecdotes, I was hearing a story the other day. I was at a commercial vehicle conference, and this relatively small business was saying they'd aim to put in 10 charging points for a fleet of, I think, about 40 vehicles. But actually, when it came down to it, the constrictions around premises, power and everything else, then they could only put 4 charging points in.
Okay, yeah.
So the sign-off for investment that they had was there, but then the practical considerations made it more challenging. And I think these are the sorts of things that I think we're starting to discover, and they're interesting. I think optimization of charging is really important as well. So I think thinking about, where is charging going to happen? Is it at a central location? Is it going to be out and about? Does a person who has the vehicle have to do it at home? How are we managing that from a predictability point of view? And particularly for organizations that are thinking about on-site charging, it's like a car, what's the best way of utilizing that asset? Because if it's away from the location for a large proportion of the day, you've spent all that money on the infrastructure and it's actually only being used 4% of the time. So we're seeing definitely, I think First Bus publicised last week in the UK that they've created these sort of multi-use charging hubs out of their depots. I think that's really exciting, really positive, really innovative. They've worked out, again, been using electric vehicles for a number of years. They have a charging cycle which is predominantly overnight. Their buses are out during the day carrying people around. It's empty, not utilised space. So they've thought of that and they're now providing that as a sort of service, which is great.
Absolutely. I mean, makes total sense. And again, without opening up that whole can of worms, but I definitely think across commercial and retail, there's a real opportunity for kind of sharing of those locations. Not everyone needs one at home. Not everyone can have one at home. I've got one on my driveway right now. There's no cars at home because one car's at the station and my wife's out all day. So that could be being used by someone who doesn't have one. There are services that exist to facilitate that, but it's very much sort of almost community led and in that sense. But, so having some way, say both on commercial level and private level of being able to share that infrastructure that in a way is already there, it's been put in. It makes a lot of sense.
And again, it's a new risk. Okay. So again, we're thinking about using, in your example, your driveway in a different way. Okay. And so going, well, how does that impact? Because you want to use that for social utility, which is allowing someone else to charge. But then someone's going to go, well, what happens if that charging goes wrong and, it impacts on your property? So again, this is where the insurance market needs to be brought up to date. the rating of the charging infrastructure you have there. All those types of considerations are important.
Yeah, absolutely. Yeah, people come just thinking about how narrow my driveway is and how often I nearly crash into the neighbour's house when I'm reversing in, let alone someone new to it. So just managing all of that. And finally, we're going to get to data. So teasing, we're now on the highlight match of the day on Match of the Day. Leaving ourselves just about enough time to scratch the surface, I think. So a few places to start here. You guys have a really interesting product called the Motor Risk Analyzer. I think we'll maybe come on to that shortly. But I just want to talk more high level, I guess, because and you've been involved more closely with it. But we've worked on a number of projects on pay-per-use, data-led, driver score-led insurance type products. And I feel like kind of pre-pandemic to 2018, 2019, that was sort of the talk of the future of fleet policies, particularly where it was the vehicles were in use a lot of the time. Uber drivers, delivery riders, that kind of thing. It was going to be how things, and that's not really taken off. Give us your sort of take on that.
So I think it's I think the reality didn't meet the ambition is probably the short way of doing it. I think part of the challenge here is, and actually it's an increasing challenge. It comes under our tech banner, but everyone talks about data. Data's the new oil, blah 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 blah. But I heard a very good analogy recently, which was, crude oil is not really useful. You have to refine it for it to be useful. And ultimately, that's when it has an economic value. And data's the same, really. A lot of data of itself is not valuable or useful. And I think what happened was people fell into the trap of just saying, okay, we've got all these brilliant data points because everything's connected. And, and I certainly dealt with or spoke to companies that were in that space. And they really didn't have an idea of how they wanted to use the data. And I think, to some degree, OEMs are in that challenging area because they know they're sitting on a lot of data from their connected vehicles, but they don't know how to monetize it. And so the price of data coming out of OEMs is very expensive. And I think part of that is because if you just treat it as one big data packet, then it's going to be very expensive. And actually the key is what data is important and how are we going to use it? And I think what we saw in some of the pricing models was a promise to use data and enrich it. But actually, all that was happening was people were just tracking miles.
Yes, absolutely.
And I think, so actually then you're not very far away from a traditional insurance model from an exposure point of view. I think there is a twin thing around the reliability of data, because if you truly want to use the data to price on risk, you have to be able to explain it. And I think we talked about that earlier. And so if you make a risk model too complex, it becomes difficult to explain to a consumer. And then you also have the challenge of we're happy to use a risk model if it makes our insurance cheaper. But actually, if your model says I'm a bigger risk, then I'm less happy about it. So I don't think we've got that balance right at the moment. I think, if we think about the subscription models, I think it's interesting there. You mentioned Hertz earlier. They've got a fantastic amount of data on their customers. They're very good at understanding the profile. But what we do see is that sort of same ethos in terms of understanding customers is not necessarily applied to with a risk lens. And I think that's where we're interested in terms of using data to go, actually, what are the attributes that create risk? And then can we identify and measure? Because I guess as a business, we're about risk identification and quantification. But we want that to be fair. It needs to be transparent so we can explain it. And I think our bottom line is we have to take people on a journey. I think we have to get people to understand and be confident and happy with what we're collecting and why we're collecting it. And once they understand and buy into that, then you can take it to a next level. I think, again, you can't miss steps out in trying to get to the goal if you want to price off of data ultimately. So, and I think that's the other challenge is people have probably tried to run too quickly. rather than take it incrementally.
Yeah, definitely. I mean, the example that we had actually of our first ever commercial project just pre-pandemic was, using data-based insurance for Uber drivers was super exciting. But actually, the first step and the only step that we ever got to working with the insurer was to give them mileage. We were doing daily mileage reads and sending it to them. But actually, that is hugely more sophisticated than a large proportion of insurance policies. But it's not actually that sophisticated in real terms.
And mileage is, it's a different, mileage generally is associated with increased risk. But actually doing miles in London is very different to doing miles, in a different urban geography or in a rural area. So again, there are nuances around risk, and we see it from the different organizations that we work with, that actually it isn't the answer. And actually, increasingly, we do see that actually it is that, the human factors associated with driving are important. We have an assessment business within our human capital side, which look at a person's propensity to take risk. Which is really interesting because that can impact on decision making and the way in which you drive. So I think we're looking at these factors and saying, actually, are they identifiable? Are we confident that they are transferable in an equal way? And then how can we utilize that?
Yeah, definitely. And I think there's definitely some interesting stuff. Again, everyone with the connected vehicle data, everyone sort of jumps to those sort of risky driver type analysis. I think there's some stuff that in the upfront stage, I think I've talked about a lot, but particularly with the use of our technology, it's like knowing who the customer is and where the car is, stuff like that. It's going, well, actually, when you're an insurer, if we can provide the information that says the customer's performed an ID check, we've done these steps, we know they are who they say they are, we know where the vehicle is at all times because we can track it and immobilize it, you kind of go, okay, right, well, that ticks or helps to soften an element of risk. And then you can get into is it a risky driver? How much are they using it? Those kind of things. But like you say, there's a bit where we've got, look, we've got all this data. That's amazing. But the synthesizing of it is the tricky part. I also agree with the stuff about the OEMs. I've been openly critical for a long time about their connected car data. They would be much better giving it away to people for free now, letting people create really, really useful use cases for it and then applying a small charge afterwards. Because right now everyone goes, that's really expensive. So unless I've got a really, really important use for it, I'm not that interested, or I'll put a tracker in.
I have some sympathy. I understand, there will be costs, incurred for them, if you think about the sensors and the data they have. And also they're obviously, as with any business, worried about the intellectual property that might be associated with it. But again, I think it comes back to going, I think we need to be more structured in saying, we don't need everything. Don't want everything. Do I want every sensor reading that's on that vehicle? No. Actually, what are we interested in from the vehicle that would help us? And I think that's where, as an industry, I think the insurance industry needs to be better. We need to stop sort of saying to OEMs, guess what information is important to us, and we need to say to them, this information is important. This is why we want to use it. It's actually there's a social utility in using it, because ultimately you were trying to drive improvement and safer travel. Yeah,
absolutely. And it's back to a little bit like with a lot of the tech business thinking about Google and Google Maps, that's because it's a free tool, it gets used, it has users, it has adoption, it's a useful product. And then you can start to sell advertising for the businesses within it, and that type of sell some of the background data, then sell it. And I think the OEMs have gone straight for we've got this thing that's really valuable and we're not prepared to let it go unless we get a lot of money for it. And actually it is super valuable, but only when people have built important, valuable use cases from it. Just want to make sure that we touch on it a little bit as well. I mentioned the motor risk analyzer, just a product that you guys have, but just interested to hear a little bit about that and how you guys are using that with fleets.
So we call it sort of motor risk insights, and so it's a connected commercial vehicle proposition. Based off our learnings from speaking to customers and insurers, what did we hear? Lots of data, but underutilized. And actually, the biggest challenge is, how do I cut through the noise to derive true insight? Because there's a difference between data and analytics to insight, which helps inform decisions. So we've stripped it back. We work aggregating telematics data and turning that into an understanding of risk exposure. So not where a vehicle is driven from a tracking point of view, but actually trip exposure. So miles and trips, important for us, because actually understanding volatility around numbers. Again, post-pandemic, we've seen numbers of trips go up, mileage go up, increased risk. So really important for us. But then we apply a proprietary risk scoring methodology to it. Now, importantly, we're not trying to price off of this, right?
Yep.
So really important. So coming back to we're trying to educate. So actually help organizations understand where does the risk sit within their fleet or their vehicle operations.
Yep.
And then support them in terms of directing towards action.
Yeah. Okay.
So for us, it's much more about that sort of informed advisory piece to make change. Our data analytics is based off of what we know to have been high or behaviours which contribute to on-road accidents. That's really what we're concerned about because it has the biggest impact on insurance price.
Yep.
So we're tracking those long-term trends, and then we deliver insights to our customers and help them in terms of planning, in terms of what they can do. I think the ancillary benefit of this for us is actually the forgotten side of risk, which is we always think about the bad. We don't think about the good. And actually a big part for us is how can we incentivize and reward the good risk within our portfolios. And actually in subscription models and things like that, where you think about the products that you can bring in, that sort of gamification, incentivization is really important to us because I think in the mobility space, it's often been left behind because insurance industry is very backward looking at accidents, problems. And actually we forget that there are, you apply the 80-20 rule, probably in most fleets, a large proportion of the people operating vehicles are very safe. So actually, how can we leverage that to convince the insurance market that actually risks are perhaps less significant than they perceive?
Yeah, a bit more of a carrot rather than the stick approach. Yeah, definitely. Yeah, definitely could see that working.
Yeah, well, a colleague of mine who you know very well, he likes to use the analogy of we beat them with a carrot.
Right. Okay.
So, which I think is a great way because I think actually, we should be using the carrot as the incentive to bring other people along, not the other way around. Yeah,
I already found the title for this episode, Beat Them with the Carrot. So just finishing up, and I said that we wouldn't leave ourselves enough time to do data justice, but we knew that was not even a podcast episode in its own right, but probably a series. But just the final bit on data and then kind of moving a little bit into just where you see the market. But just a point around some of the camera systems that we talked about earlier, actually in the claims side or the kind of repair side, but that kind of being the next layer of telematics data. So appreciating that we've said already we've got too much data we don't know what to do with, but is there a case that we're going to end up skipping things like mileage data and actually just jump straight into some of this more advanced stuff?
Yeah, I mean, I think potentially, I think firstly, cameras have been around for a long time. I mean, I'd say I've been consulting for nearly 20 years and certainly for more than 15 years, I've dealt with very large businesses that have used both external and internal cameras. So I think, the information has been there. I don't think it's been widely adopted, partly because of cost and use. I think cameras have an immediate effect, a potential defensibility impact. And from an insurance point of view, that's typically been the primary reason for utilizing them. I think that they do have other ancillary benefits around coaching, risk improvement, and actually just providing very, unequivocal evidence as to a behavior. So very positive. And certainly where we see examples where people are very resistant about using particularly inward-facing cameras. But actually, when you educate clients and educate drivers, you see that actually it should be used as a support tool for them, actually. And in many cases, I've seen very good examples where it's exonerated drivers in quite significant accidents.
Right, yeah, okay.
So I think it's super important technology. I think, but the challenge is always, most accidents occur because of human error. The person driving the vehicle. So until we have truly autonomous vehicles, which is some way away, and we can perhaps have that's a separate subject in itself, but there's some great innovation in and around that of itself, right? That's really exciting for us in terms of accident prevention. But actually, the human factors are still really important in terms of it. I think cameras help with that because you start to reduce the number of distraction events or other behaviors which can cause challenge. I think when we start to think about what a camera is capturing from a road and risk perspective, then yes, definitely. And again, we see that with the certainly all of the players in the autonomous vehicle space, their combination of LiDAR, radar, camera, and how they are thinking about hazard identification and assessment is very, very interesting. So I think they're definitely leading in that space. I think there is a different challenge from in the interim, which is vehicle assistance technology. Is providing more alerts to a driver in the cab.
Yeah.
But actually, you're still reliant on a driver doing something.
Yeah.
And I think that actually we see as a new emerging risk, because you become more and more reliant on the technology. Are you ready to take back control of that vehicle? So yeah, I mean, it's definitely a really interesting area for us, and we'd put it in that. How do we use it positively to identify risks in a way that supports use cases?
Yeah, interesting. Yeah, definitely. An area that's going to evolve a lot, I guess, over the coming months and years. And just finishing up then in terms of like a prediction, if you were looking at something to look for, something to be aware of in that insurance space, what's the next 12 months looking like for you?
So I think for me, I think when I look at the market now, I think actually, it almost feels like battery electric adoption's past the tipping point. I think people are really, those who have converted to it are sold on it and really positive. So actually, I think that's going to accelerate, because I think they're becoming advocates for increased change. I think battery technology is the interesting area. I think to solve some of the challenges around this worry, not so much range anxiety, I think that's gone. But actually, my asset going to fail? I think that's really interesting. And I think some development around products using a true understanding of battery chemistry is going to be a big changer. And then I think this piece around the social utility of shared charging infrastructure. Yeah. I think as we get businesses to think about that and organizations to think about it, it will create an unlock as well. So I think there's real potential there, as you say, to multi-use charging will it takes out the challenge around range anxiety for organizations, because they're worried about downtime. That charging cycle time for them is off-road. That means my asset is not utilized. So that type of network approach can really support uptake, because it reduces that as an issue.
Yeah. Okay. Yeah. Lots of definitely interesting areas to come in the BEV world, as it's talked about a lot, and I think particularly the lot of the challenges we've talked about today, and seeing how those progress and evolve over time is going to be super interesting. Marc, thanks so much for your time. Really enjoyed it. I knew that this would be a lot longer one. There's so many interesting topics to cover, and I think definitely get you back again, particularly on the data point would be fantastic. Thanks everybody for listening and watching. If you enjoyed this episode, the rest of the episodes are available across all of our channels: YouTube, Spotify, Amazon, and Apple Podcasts. Thanks very much again, and we'll catch you next time.